Are you procrastinating investing because you're constantly second guessing which accounts are right for you? If so, this episode of Sundays with Steadyworth is for you.
Yes, most people focus on making more money, but fail to focus on where the money goes once they make it. And the account that you use will either slow down or accelerate your wealth. So in this episode, we're going to be breaking down the 5 accounts to grow wealth. My name is Gabriel Walters. I'm a CFP professional, a certified financial planning professional. I'm also founder and owner with Steadyworth, along with my wife here.
I'm Laura. I'm a life and leadership coach, also co-founder of Steadyworth. Super excited to be with you tonight and break this down. One of the most commonly asked questions we have is, which accounts should I have? Should I not have? This is a source of a lot of confusion for people, and we want to just break it down tonight and make it simple and easy for you to understand and apply.
Absolutely.
So to kick off, where do you want to kick off?
Yeah, let's just hop right on into the questions.
Okay, so account number 1. This is probably the most basic, and you probably already have this, but we're going to talk about how this plays into your bigger goal of growing wealth and growing your growing your wealth.
Yes. And so this is 2 accounts, but we're going to label it as 1 account, and it's your checking and savings account. But in theory, they're used for the same thing. And this is for short term. This is for money that you have that you're going to be needing to use in the short term. And so this is where I feel like a lot of people get caught up because they make a lot of money. And this is where they end up parking that money, is in their checking and savings account. But really, the checking and savings account is just an account that you hold money in, and so like when you're paying bills, or it's the money for you to receive. So if you're receiving payment, you receive, if you're likely, somebody sells you, or sometimes like even in a business, like this could be your business checking account, where this is where you receive payment, where you cash checks or receive Zelles, or your Stripe account hits. This is where you receive your money. This is also the account that you pay bills out of. And so this is an account where that's just, that has a lot of income and debit. And so I look at the checking account as the one that, that you're spending money out of, that, maybe you're paying your credit card payment back, or you're paying your bills with. I look at the savings account as accounts that you're holding money in. And this may be for a little bit longer term. This might be like, hey, I'm going to need $10,000 next month because we have some expenses. So I'll peel that off to the savings account and have that there. And then checking account is for things coming in and out. So what do we want to touch on for these 2 accounts?
Well, my first question is, these are pretty basic accounts. So we're assuming that most people watching have this, because if you're getting paid, you're likely getting a direct deposit into your checking account, right? Yes. So the question that I have is like, okay, if my saving, or if my paycheck or my income is dropping into my checking account, what might be the first thing that I want to do with my money in order to, I know we're going to talk about other accounts as well, but like, what should I do?
So I would say your checking and your savings account, like when you get paid, these accounts are the ground zero account for your budget. And so,
okay.
So as when you think of like, hey, I need to build a budget, I feel like these are going to be the first accounts you need to look at, because these are the accounts that feed all the other accounts. So this is what's going to feed, if you have investments, this was going to feed that. This was going to feed paying back a student loan, paying off a credit card bill. This is going to feed the savings account. If you have, if next week you're going to Italy, next month you're going to Italy, and you're like, hey, I want to take some of this money to do this. For me personally, I would be peeling some of that money out of my checking account and putting it over into that short-term savings account. This is what's going to help you, from your checking account. This is also where you're going to send money to fund that short-term emergency fund and things like that. And also in these checking and in this savings account, I would look at maybe that account that could be, you could have multiple savings accounts, but I have one, and I look at it for 2 things. I'll have one in a certain amount, and that would be my emergency fund. And we generally earmark, would say somewhere 3 to 6 months of hard expenses as an emergency. But then I could also have money in that same account that I look at as things that I'm saving for in the short term. And one thing that we've said before is that all funds can be used for an emergency, but all funds should not be used for savings. And what we mean by that is that all the money you have, if you have an emergency, of course you could use it for an emergency. But I look at money that I'm saving, like short-term savings. I may be having short-term savings because I want to go buy a new set of golf clubs. Or I want to go on a vacation, or I want to go do some other high purchase that I just have sitting in the savings account. I do not look at emergency fund money as money that you would go make one of those purchases with, because going on a vacation, golf clubs, a sale, Laura gets Lisa Eldridge makeup. That's not an emergency. And so we want to make sure that I look at these two things differently. Even though I may have some of the money in the same account, they're two different things. So emergency funds and savings for short-term bigger purchases are two different things. And so you want to make, and so if you don't see them that way, maybe you should have them broken out in two different types of savings accounts. But yes.
I was going to say, my brain can kind of lump it all together. And I'm assuming that might be the case for some people, watching as well. Are there accounts or bank accounts that let you have multiple savings accounts? And
like,
can you title them?
That peel it out in like buckets?
Yeah.
I think, I have not used any. And I mean, I bank basic like Chase, Wells Fargo, Bank of America, those types of accounts. But I'm sure that there are, some sort of banks that do that. But honestly, I haven't looked into those. Generally speaking, historically speaking, if I've needed a separate account for something, I've just opened it, and I just haven't gone and looked for another bank that has sub accounts inside of an account.
Yeah, I've heard that Ally, you can create different savings accounts and label them. But I don't Ally Bank, but I don't know that for certain because
do know that, like, so at every bank, every bank that I've banked with, you can rename whatever, name your account specifically. So like in the accounts that I have, I named them.
Okay.
Each one has its own name.
Okay. Got it. Yeah.
But it's still a separate account. It's not like a sub account under account.
Yeah. I feel like sometimes when we're spending money, saving money, it all feels the same, like it's all going out, and it's not like back in the day when our our grandparents were writing checks at the grocery store, and you were a little bit more thoughtful, or you were forced to be a little bit more thoughtful about the money you were spending. Whereas now, you swipe the card and you don't really think too much about it. So I feel like sometimes those separate accounts or those separate titles might help someone organize their money in a way that's more conducive to their overarching goals, right? Like if you want to create a save, or if you want to have, bolster up your savings account for a vacation or golf clubs or whatever that is, and you want to save for emergency fund, it might help delineate and make that goal even more clear and crisp, so you're not getting confused or sidetracked, because it's so easy to do that nowadays.
Absolutely. I mean, like for a checking account, I guess maybe you haven't seen this, but I've renamed our checking account. I call it everything.
Oh,
because everything comes into it and goes out of it.
Yeah. Okay.
And so whereas, savings account, I've named it rainy day.
Okay. Got it.
Rainy day savings. And then, and so forth and so forth. So I have, a different account that managed some property with. Those accounts are named the property names, and so.
Yeah. Okay. So
it
just keeps it
all
really
separate accounts. They're not sub accounts. Each account has its own account number.
Well, and I think that's really step one when it comes to organizing your money. I mean, it sounds silly, but like having some of those categories, separating some of that money out really helps you stay clear about what's what. And I think even that small little step is going to help you get out of potentially the paycheck to paycheck mindset, right? Because I'm curious to know, and if if you're watching this and that resonates with you, I'm curious to know how you organize your basic funds, right? If it's delineated out enough for you to go towards these different areas. But I think it's an interesting place to start because it is the most basic and it's kind of the assumed accounts, but there is a lot you can do to organize your money in that space. And we always talk about, if you really want to get to know yourself or someone else, reviewing their bank statements is one way to do it. Of course, you can't review other people's bank statements off rip, at least not yet. Hopefully we never get there, but right. It'll tell you a lot about what you value. And For those of you who are joining, please say hello in the chat. Let us know if you have any questions. We are going to stay a little bit afterwards and answer questions. But also, if you have not liked, subscribed, we would love for you to do so. This is a new show that we're doing, and we are wanting to put out content that resonates with you and answers your questions about money, life, career. And so it would be helpful to like, share, subscribe. So just a short recess for that. But yeah, so the next thing, I mean, we've talked a little bit about emergency fund, but I kind of want to move into this next account, which we talk about, which I think there's a lot of buzz around, which is the tax-free retirement accounts.
Yes. And so
Can
these
you touch on those a little bit? Just give us a quick overview.
Yes. And so in these, we're talking about the Roth IRA and Roth 401k. And so everyone has access to a Roth IRA. Not everyone has access to a Roth 401k. In order to have access to a Roth 401k, it would be something that would be offered through your job, and they have to have that built in to their suite of retirement options accounts that they give you.
Package,
and so what'd you say?
Benefits package.
Yes. And so the main difference is being that the Roth IRA you can contribute $7,000 for the year of 2025, plus an extra $1,000 catch-up contribution if you're 50 or older. And for the Roth 401k, it's $23,000 or $23,500, I believe, for the year of 2025. And then if you're 50 or older, it has a catch-up provision where the total contribution amount you can contribute is up to, I believe, 30. It'd be 31 total. So 23 plus, yes. I don't know the math. I think it's like 7.5 more, which makes it about 31. And so if you have access to your job, if your job allows you to have one, or if they have that built into their benefits package, it can allow you to save a lot of money in this type of account, whereas you're limited if you just have a regular one. But they're great accounts. And how these work is, let's say you make $100,000 a year. If you contribute the $7,000 and you're under age 50, you contribute that $7,000, you're still taxed on the full $100,000. So you don't get a tax deduction for the amount that you put into this account. You're still taxed. You pay taxes on this money before it goes in. But then as long as you keep the money, as long as the account's open for 5 years and you're over age 59 and a half, when you pull the money back out, all of the earnings that it's made grow tax deferred. And so that means that they grow tax deferred, and you don't have to pay any more taxes on them. So
it's not deferred, it's free. Like they grow tax free. Yeah. Okay.
Right. That's what I'm going to say. Yeah. Not tax deferred, but tax free. Yeah.
That's a huge benefit when you really think about it, because I think when I think about investing a certain dollar amount, I'm not really I know this sounds silly maybe, but it's like, I'm not really thinking about what that money is earning. But the fact that you put it in and you've already paid taxes on it, and then everything that it earns is also tax-free is kind of like the hook. It's like you wonder why people are not doing this right out of the gate of their career, because the compounding over time would be so significant, and you probably would have a great deal of earnings that you would not be paying tax on. So it's a really great account.
Yes. And for those of you guys, I just want to take this, go step back one more step. And so because we're touching on 5 different accounts here. And so the first account, which is your checking and savings account, that's just a bank account. And it doesn't really pay much interest. So now this next account, which we're talking about, which is a Roth style account, which we're talking about the Roth IRA or the Roth 401k. This is an investment account. So this is a type of account that's earmarked for retirement, but it allows you to buy basically investment instruments. So like stocks, bonds, exchange traded funds, mutual funds. You can't buy these inside of a regular checking or savings account. You have to buy these inside of a certain type of investment account. And so that's some of these accounts that we're going to be touching on. And the reason why we're talking about this is because if you just leave your money inside of a checking and savings account and receiving the very small amount of interest that a bank pays you, over time, you actually start to lose money due to inflation and due to when the government prints more money. As more money goes into circulation and as prices go up, you start to lose buying power. So even though you may have $10,000 in that account, after it's there for years and years and years, you will see that you can't buy the same amount of products or goods and services that you could have with that money just sitting there. A great example of this, and I'm just going to use my parents for an example. Back in 1988, they took out a loan and they bought a home, and that home was $89,000. And so they took out a mortgage, they bought that home. And now over time, as the market has grown, inflation has happened, more money has been printed, prices have gone up, real estate has appreciated. And so now that house is, let's say it's worth $750,000. Now, if they just had that $89,000 loan and just put it into a checking and savings account and just stayed there and just paid it off, it would still be $89,000. It might be 92, 93 with some interest. It wouldn't be much more than that because the bank doesn't pay that much interest. But now that home has grown. And so that's what I'm saying about losing their purchasing power. They couldn't 20 something years later say, hey, we still have this $89,000. We want to go buy that house. They wouldn't be able to buy that same house that they were going to get in 80s with the same amount of money. That money has now lost its value.
Yeah.
And so that is why we were talking about these different accounts, because you want to make sure that you're maintaining your purchasing power so that if it's parked in an account, when you're ready to pull it out to just go buy something as simple as go to the grocery store, or if you're buying a home, a car, if you're paying for a child to go to college, if you're paying for a wedding, a vacation, you want to make sure whatever money that you've earned, whether it was this year or 10 years ago, it still has its same value, if not more, when you go to use it. And so that's the importance of these 5 accounts that we're speaking of today. The other point of why we're speaking on all of these accounts, and I will re-summarize this at the end, is that when you are, as you're saving for retirement, as you're saving for different high-end purchases, and as you're just building wealth, there's 2 things that you're going to constantly be focusing on is which way do I need to be able to access this money? Do I need to be able to access it today or in the near future? Or can I wait to access this later, like after age 59 and a half for retirement accounts? And also, at what level will this money be taxed? Because even though you don't like paying taxes now, none of us like it, but we have to pay them as part of our life. We want to make sure that we're setting ourselves up to be saving and paying the least amount of taxes that we can pay now, but we're also planning our strategy to have the most tax efficient future that we can have as well. And so that's all part of the strategy of these 5 accounts is helping us out with how we're going to access money now and later, and how we're going to pay taxes on money now and later as well. So we're going to hop back into these 5 accounts. We just touched on checking and savings. Now we touched on Roth accounts. Is there something else you wanted to talk about inside of the Roth accounts?
No, I think you covered it. I mean, the main point here is, what you just said around taxing, being the most tax efficient now, but also being the most tax efficient later. And this Roth is really about being tax efficient later.
Yes.
Right. And so there's a benefit to it that's, not necessarily in the here and now, but in the future is really going to benefit you and help you, pay your bills and live your life, later. And I think a great point that you made, one question that we have here is like, why don't you think people take advantage of Roth accounts?
Yeah. Well,
my first thought is like people don't really understand them or know about them.
Yeah. People don't understand how they work, or they don't know what to put in them, or they don't understand the power of them. And so if you don't understand it, and maybe if you need a little bit more help, because we're just touching high level, this could be a great time for you to send an email to hello@Steadyworth and book a call with us. We can set you up on a complimentary call, and we can answer some questions about where you would set up a Roth IRA. That means the custodian. So, if you have a regular checking account, maybe you have it at Wells Fargo or Bank of America or a Chase or a credit union, that would be your custodian for your checking account. But you might say, hey, I want to set up a Roth IRA. Where can I set up that? And so we would look at different custodians, maybe like Charles Schwab, Fidelity, Robinhood, different ones, Vanguard, ones like that. And so if you need help, or if you don't quite understand how those work, or what the difference is, feel free to book a call with us, hello@Steadyworth, and we could help guide you through what custodian would be right for you, how to set that Roth IRA account up, and what are the things that would actually go into it. Because the thing is we want to make sure we make this clear. You can set up a Roth IRA and put your $7,000 in for it for this year, put your 7,000 or whatever the amount is going to be for next year, because every so many years they up the amount, and you can be constantly contributing to this account. But if it's just sitting there in cash and you haven't bought any investments, it's the same as it just sitting in the bank.
Right.
The thing is that these accounts, they can hold cash, but they also allow you to invest in the stock market. If the money's not invested, it won't grow. And this is actually something that I was reviewing with the client. One client, they said, hey, this one account I'm in, it has been growing. This other account I'm in, it has done nothing for the last 3 years. And so I said, interesting. Let me take a look at it. And so we're on Zoom and we share screens. And I said, well, you know why this account is not growing? I said, because it's sitting in cash. And because, when things sit in cash, it's not invested in anything, so it won't grow. And she was like, you know what? You're absolutely right. And so, but the thing was that she didn't know how to read the statement. And so that's one thing that we guide her to. So it's like, hey, if you want to get this account invested, let's hit some, let's pull some levers and get this account invested so it can start making money for you.
Yeah, I remember that conversation, and it's really easy to do because you kind of just assume that it's just invested.
Right. But they won't automatically invest it for you. In your 401k, very likely that a lot of programs will automatically invest that one for you in your traditional 401k or possibly in your Roth 401k. But in just a regular IRA that you set up, when you put that money in there, it's going to sit in cash until you actually, till you actively, decide what you want that to be invested in.
Yeah. And like Gabe said, there should be a link in the description where you could actually book a call. We have a complimentary, like strategy call that we offer people to just kind of review questions, help them figure out different things. And so that link is actually in the description box below already. If you don't see it, just send something in the comments and I'll share it via the comments as well. But I think what you just touched on is that we're kind of moving from this Roth IRA account into a traditional brokerage account or yeah. So I was going to go to the non-tax retirement account, but the next one we have listed here is actually a traditional brokerage account.
And so this is the third account type of account we're touching on. So the first one was a checking and savings, which is an account that you would have at your bank. The next one was a retirement account, but it was a Roth retirement account. And it's the most tax advantaged retirement account that you can have, as in it grows tax free because you pay the taxes on it, and it's tax free as long as you take your distributions at age 59 and a half and the account's been open for 5 years. The next account is just what we call a traditional brokerage account. And this account is not connected to retirement at all. This is an account you can, doesn't have a contribution limit on it. You can put in as much money as you want to. Since it's not connected to retirement, you can pull that money out. You can put it in, pull it out, put it in, pull it out. You can access it as freely as you want to. And it does have a tax benefit to it. And so let's say you put $5,000 into this account, you invested into something, and that $5,000 grows to $10,000, and now have a $5,000 investment gain in this account. You have your $5,000 basis and your $5,000 investment gain. Now, as long as you don't sell that investment gain and you hold it for over 1 year, it gets taxed as long-term capital gains, which is a preferable tax rate depending on your income. It could be somewhere between 0 and 20% for long-term capital gains. If you do sell that thing in less than a year, you've held it and you sell it and you haven't held that capital gain, that asset that had the capital gain for less than 1 year, it will be taxed as ordinary income. And so basically it'd be taxed as how your ordinary income is taxed.
Okay.
So whatever income level that you're at for salary and wages that you receive, it will be taxed at that rate, which is going to be a much higher tax rate than a capital gains tax rate, which is maxes out at 20%.
So just to recap what you're saying, you've invested $5,000, right? This would be a potentially non-realistic example, but let's say it grew to 10,000 in year one, right? Like you doubled your investment.
Well, let's say it's real. If you bought Robinhood stock, and you can go back and watch the video like we did, and I wasn't giving this as an investment. I'm not giving this as an investment advice, but we have a video on our YouTube. It's called One Stock, 1 Year, 80,000. And now that one stock in about a little bit over a year has made more than 80,000, but we bought Robinhood shares and we bought them at somewhere between $22 and $25 a share, bought a little bit over 1,000 of them. And they were between $22 and $25. just a week ago, it was at $153 a share. So it was over a 500% gain, not 100%, not 200%, 300%, 500% gain. And so if you had to put $5,000 in there last year in this type of account,
Fair enough.
you wouldn't have just doubled your money. It would have turned into like $20,000.
Right.
Yeah.
So it is possible.
So it is definitely possible.
It's definitely possible. It's not guaranteed.
Now, everything you invest in will not do that. And I'm not saying to go buy Robinhood shares and it's going to do it again. I'm just sharing with you something that we did and it happened.
That's right.
This is not investment advice. I'm just sharing an example.
Right.
Yes. I've also bought things that have gone down in value, bought things that have stayed stable, and things that have gradually grown. And so, yes.
So, and just to kind of like bring this full circle, for like a traditional brokerage account, there is no contribution limit. So you can put as much in there as you want.
That's right. So you could put $20 million in there once you sign this next big deal for, yes.
For whatever it is.
Yeah,
or you get that job or whatever it is.
You win American Idol and you sign with that record label and you're singing along on the stage with Justin Bieber, you could put your $20 million advancement into a traditional brokerage account. Now, they will not let you put $20 million into an IRA at one time. Remember, it maxes out at $7,000, whether it's a Roth or whether it's a traditional, but into a regular brokerage account, you could put your $20 million in there.
So, and then let's say, and then if you were to take any gains out in the first year, you would be taxed at regular income.
Less than a year.
Less than a year, yes.
So that means your capital gains need to turn 1 year. They need to have a full birthday, at least 1 year birthday to be considered a capital gain.
Okay, got it.
To be considered a long-term capital gain. A short-term capital gain is anytime less than a year.
Right, and a short-term capital gain is taxed as regular income.
Ordinary income, yes.
Okay. And then you just said if it's after a year, it's long-term capital gains, which is significantly less depending on how much you make.
Yes. And when you think about these taxes, it's like you might think, well, how much money am I paying in taxes? Does this really matter? Now, on smaller amounts, you might not see it as much, but imagine you're growing these accounts and you're growing it. And as they grow, you're getting 50, 60, 100,000, 200,000, 300,000. This really starts to make a big difference when you have that type of money and it's being taxed as a long-term capital gain. It's very tax advantageous for you.
And correct me if I'm wrong, but a majority of people who are creating financial freedom for themselves are investing. I mean, they're investing in all sorts of different channels and avenues, but like if you really are looking to create financial freedom earlier in your life, they're investing in a traditional brokerage account.
Yes. I mean, you could be, the thing is you could be investing in a mix of these accounts.
Right.
But the earlier you start investing, the easier it will be because you have time on your side. And that's the thing about compounding. Imagine. I don't know what just happened.
You're cutting out a little bit.
Yeah, it literally on my screen, it happened to both.
Oh, okay. Well.
Yeah. And so we were talking about having time on your side when you're investing in these types of accounts. The sooner you want to start it, because imagine if you put money on a credit card. I'm assuming everybody watching has possibly put money on a credit card. But if you've ever got into debt, say you've charged $5,000 on a credit card, how fast do you want to pay that off? Really as fast as you can, because if you have that $5,000 sitting on there for a year and you're paying the minimum payment, it's not $5,000 anymore. It's like $5,500, close to $6,000. Then if you have it for 2 years, it's growing. Well, think about your brokerage account or your Roth account or any of these accounts that are invested. They're doing the same thing, but you're getting that compound interest working for you. So as you're getting that compound interest and that investment gain going, it's growing each year. So the thing is the sooner you start, the longer you have for it to grow. Yeah. And that's why you want to start soon. I mean, I was just working with a few young men from my church. One's 18, one's 20, and they started it. And so they started their accounts. So the thing is that I started investing in my 30s. So since they're starting in their 20s, they will be able to contribute less and make more and less, and for a shorter amount of time, and still have more money than than I have right now in my 40s than I
Right.
would have, because they have more time on their side. Their money is going to be, by the time they get into their 40s, just because their money's been working longer. It has
Yeah.
more experience working longer than what my money has. So the longer you wait, the more you have to contribute to catch up to, if there's like a certain amount you want to do.
And I think the point that I'm making as well is, like, if you're planning on taking, like, let's say you have this dream, you're 30 now and you have this dream at 40 to take a year off and travel the world. Investing in a brokerage account for that trip would be more ideal than putting all of your money into retirement accounts, because you can't pull that out before you're
Yes,
59 and a half.
there are ways to access money that goes into a Roth account, but I won't get into the weeds with that. But yes, there are the best thing. If you were in your early 20s, I'd say put that money in your brokerage account, and especially if you're planning on using it, like say in another 10 years, let it grow, and then you can access it on whatever level you want to access it on. Another thing that you can do, and this might not be, once again, this isn't investment advice. And I would think about when I was watching
Education purposes
the
only.
Teenage Mutant Ninja Turtles as a kid, and they would be about to do a stunt, and they'd say, "Kids, don't try this at home, but don't do this unless you've spoken to an investment professional that can speak into your situation." But another thing about having it into a brokerage account, let's say somebody has grown their money, and they're just like, "Hey, I need to get some money, but I don't want to sell. I don't want to sell my investment positions." They can actually take a margin loan against the assets in their brokerage account. So let's say they have 300,000 in there, and you can do this with a lot less than 300,000. They could say, "Hey, I need $25,000 to do this. What I'm going to do," they'll go and get a margin loan from their custodian against the assets in their account, and then they can pay that back, or they can take that loan out and go buy an asset with it and then pay it. They have terms. So basically they're borrowing from their assets. And why this is important is because when you take a loan out, once again, they still own the asset's still growing, and they haven't had to pay any taxes on it, because you don't pay taxes on loans.
Yeah.
So imagine if you have a $300,000 account, you pull a loan out, you use that loan as a down payment on a house or something that you're doing, and then you pay that money back. You didn't sell that. You still have the $300,000 account. It's still growing and compounding and doing what it's doing, and you're still able to acquire that other thing. This is also what happens a lot of times when we see celebrities, especially ones that have a lot of money. And you see, oh, they just bought this house in Malibu, California, and they paid $100 million for it. They likely did not pay $100 million like out of their checking account for that thing. Likely what they did is they have $100 million in a brokerage account, or more, a lot more if they're buying a house for $100 million. They'll take a margin loan against what's in their brokerage account, pull out that $100 million against that margin loan, assets still growing, go buy that property. They paid for it in cash. It's done. Refinance that property, get the $100 million back. Now they have a mortgage on it. Pay back that brokerage account, $100 million loan. And now they're paying monthly payments on this mortgage, but they were able to not even have to deal with financing initially, because they just cashed it out, leveraging their assets. And then once you own it free and clear, do you think if you own $100 million property, or even a $500,000 property free and clear, a mortgage company won't give you a mortgage against it? Absolutely, they will.
Interesting.
Yes. So this happens all the time. People take loans against their accounts, go acquire another asset, refinance that asset, pay back the loan, and then they continue to pay on that thing.
Interesting. So it's like, what's like the major benefit there is that they're not paying taxes, or how,
Well,
like,
yeah.
how
Let's talk about it again. So let's say we have, $500 million in an account, and we need to get $100 million. I know we're talking big numbers here, and we could bring it down if we need to make it realistic. Let's say you have $5 million in your account. Okay. And you're buying a starter home in the San Francisco Bay Area, which is going to be $1 million. That's very normal in the San Francisco Bay Area. It's been $1 million. You have $5 million in your brokerage account. You can go to wherever your brokerage account is. Let's say it's Charles Schwab, Vanguard. Take a margin loan, a $1 million margin loan against your account. Since you took the $1 million margin loan against the account, you didn't sell anything. You still have a $5 million account. And since you didn't sell anything, that means you didn't pay any taxes on the money.
Oh,
so like if you sold, even if there were long-term capital gains, if you sold enough assets to get $1 million, you'd likely be paying 20% long-term capital gains.
yeah.
But what's 20% of 1 million? 200,000.
Yeah.
But if you take a loan and just pull out 1 million on a loan, you're not paying 200,000. So then what you do is you take the $1 million margin loan, you go buy that house for $1 million. You then now own that house free and clear. You go down to another financial institution. Hey, I'd like to pull out, I'd like to get a mortgage on this account. They look at your assets. They see you own the house free and clear. You still have a $5 million brokerage account. You got all 5 million of it is still yours. You do have a loan against it, but all 5 is still technically yours. You refinance that property. You pull $1 million of equity out of it that you now have. You pay back your margin loan, and now you're paying your mortgage. It would, depending on your interest rate, you're paying them, $5,000, $7,000 a month on a 30-year conventional until you pay it back.
Interesting.
And you didn't pay any tax.
Interesting.
And so that is the power of these types of accounts.
Yeah. And this is something that, again, just as a reminder, this
right.
is
But that's why, but I was using
Yeah. But this is something you want to do when a financial advisor or some professional has reviewed your situation. Particularly, this is not something you want to go do with little to no knowledge based on this one little clip that you've seen.
Absolutely. But I use the $100 million thing because when you see these accounts, I just want to make it clear that these people who are doing this type of stuff, they're not just sitting with $100 million in their bank account. They just don't have that sitting
there. It's invested assets.
Yeah, they have this money invested somewhere, and they likely just go take a loan against that money, then send it to their bank account, and then do what they need to do. But people who have that kind of money constantly have their money working. One thing that we say is that rich people make a lot of money every day from the work that they do. Wealthy people make a lot of money every day from the work that their money does. Right. So rich people are working for money. Wealthy people's money work for them.
Yeah.
That's why we're talking about these accounts, is because in order to grow wealth, you have to put your money in places where it's working for you and you're not just working for it.
Yeah.
That's very important. That's the foundation of monetary wealth. Not all wealth, because we know that you can be wealth in relationships, wealth. There's wealth in health, and all types of wealth that you can create. But when we're talking about monetary wealth, your money has to be working for you. You cannot just be working for money. And that's why when you think about wealth, that's why they call it generational wealth, because you can pass assets down to the next generation. You can't pass your income down to the next generation. Like if I'm getting paid every time I meet with a client X amount of dollars, I can't pass that to my next generation if I'm not here to meet with those clients. But if I'm meeting with those clients, buying assets, those assets then in the right vehicles can be turned into generational wealth that I can pass down to the next generation.
Yeah. Yeah. So this is really like the freedom account, right? Like this is what's giving you a lot of options and a lot of flexibility and a lot of control.
Yes.
Now and in the future.
Yes.
At any point. Yeah. So
and all of these accounts will do. Yeah. I mean, all of these accounts, whether they're retirement accounts, brokerage account, all of them, they all allow you to pass them down. Like if you have a retirement account, you get to put a beneficiary on there. If you have a checking account, and if you have a checking account right now, if you get one thing, if you got nothing else from this thing, you likely have a checking account right now. Call the bank, go down there, tell them I want to put a POD, which means paid on death. I know it's terrible to think about, but if you were to lose your life, wouldn't you want your money going to somebody who you want it going to and not just whoever? And so I was just at a conference last week and they said, everyone has an estate plan. Either you make the plan or the state makes the plan for you.
Yeah.
But we all have one. So either we're going to use our plan or we're going to use the state's plan. So if you want to have your own plan, call the bank, make sure your beneficiaries are updated, and you get to choose.
Yeah.
Because if you don't choose, you're saying, hey, I'm choosing for the state to make these decisions for me. That's just how it is. It's either A or it's B. There's
Yeah.
nowhere in between it is. And
Yeah.
it can be very frustrating in legal sense and common sense are two different things. So why don't you just help everyone make sense of it for you? That is one of the best things that you could do for this episode. So if you only did one thing, add a beneficiary designation. I know that's not even connected to the 5 accounts. I mean, that's not even the basis, but that would be the most important thing you could do. The next thing you could do is start putting these 5 accounts to work for you so that you can start growing wealth. So as we touched on, number 1 is checking and savings. These are feeder accounts. This is for short term so that you can access cash capital to pay bills and feed all your other accounts. The next one was a tax free retirement account, which is your Roth accounts. Those are Roth 401ks, Roth IRAs. The next one is a traditional brokerage account. This is not connected to retirement at all. And this is the type of account that doesn't have a limit on it, such as a 401k would have or IRA would have. It is has short-term capital gains and long-term capital gains, depending on how you've held it. Allows for a lot of flexibility. Now, unless you have something else, we're going to hop into the next account, which is the regular IRA and the regular 401k. And so these are another type of retirement account.
I was just going to say, these are probably the accounts that people are most familiar with.
Yes. And so pretty much if you're working a regular job, unless you're working as a government, if you have a government job, they have a thing called a 403B, but it's just the government section of it. But it's the same, in essence, it's the same thing as a 401k. Now these, if we use our example from before, if you're making $100,000 a year and you put in $7,000 into an IRA or $7,000 into a 401k, you get a dollar for dollar above the line deduction. So that means if you're making 100 and you put 7 in, you get taxed on 93,000. So that money goes in, you don't pay taxes on it when it goes in. It's tax deferred. That means you don't pay any taxes on it while it grows. And then when you pull it back out, it's taxed as ordinary income. And I wanted to circle back on what I was just speaking about. Why we're talking about all these accounts again is because of the taxes. It's like, as we're talking about growing wealth, we're also talking about tax strategy. So remember, you don't really have to really worry about taxes on what's in your regular bank account. It's just, you've already paid taxes on that. And unless they're paying you interest, which very few accountants do, but sometimes you could have a high interest bearing account that it may accumulate a little taxes. It's going to be very minimal. But your IRA, your Roth IRA, is going to grow tax free. Your traditional brokerage account, like we said, short-term and long-term capital gains taxes. This one is going to be taxed as ordinary income. So it's going to be taxed the same rate your paycheck would be taxed. So it's going to be its highest tax rate. And why we're talking about all these different taxes is because when you get to retirement, you want to be able to have all of these different accounts that you can pull from, because being that Social Security is still around, it's going to be taxable too. And so you're going to be trying to figure out, okay, how can I make sure I'm able to have enough money to fund my retirement lifestyle and I'm still not in the highest income bracket, because every account I need to pull money from all has me getting taxes ordinary income. And so that's why we want you to have money in these other accounts. And so this account is a great account to have. This is many people's first type of investment account. If you have a job that has a 401k, you put money into it. A lot of times they're going to invest this in what they call a target date fund, which is a mix of stocks and bonds inside of one fund that's going to be target dated close to your retirement date. So it might be, say you're going to retire, your projected retirement dates in 25 years, you might be in a 2050 target date fund. So that year 2050, which is 20 years from now, 25 years from now, we're in 2025. And how these funds work basically is that they start off more aggressive. So they start off more stocks, then bonds. And then as you get closer, they become to your retirement date, they become less aggressive in theory to give you a smoother ride, which I won't go down into the weeds of investing. But, so these are some people's first, access into investing. And then, if you leave your job and you have a 401k, you can roll that over into an IRA and so forth and so forth. But these are, this is another form of an investing account. It's a great account. If you have access to a 401k, I would say make sure you're investing into it. A lot of times, employers do an employee match. And so if you don't know if your employer does an employee match, I'd contact someone at HR and ask them. Many times it's up to 3%, sometimes maybe more, sometimes it's a little bit less, but at least contribute enough so that you can make sure you're getting that match. Cause I mean, that's free money. Whatever they're matching you with is free money. You don't want to leave that on the board. You want to make sure you're taking that with you. What questions do we have for these type of accounts?
So, well, one question that I just want, or one clarifying point that I want to make is there is a 401k account, which is usually an employee sponsored account, correct?
Right.
And then there's a traditional individual retirement account, and the
Right.
contribution limits are different.
Yes.
So
And so
your
the
employee sponsored account is 23.5, right?
yes,
If you're not 50.
23,500.
And then the traditional IRA, and this would be traditional IRA would be something that you would want to get if you're self-employed, if you own a business, if you're an entrepreneur in some ways, that would be an account that you would want to get at the bare
Yes.
minimum. But the employee sponsored accounts, or the traditional individual retirement account is 7,000, right, a year.
Yes.
Yeah. So they're different contribution limits, but can you have both or no?
You can, but after you make a certain amount of money, they will reduce the amount of deductibility. And I'm not sure what the phase out amount is for 2025, but after you make over a certain threshold, they'll reduce the amount of deductibility that you can take from the IRA. So they'll still allow you to contribute to it, but it won't be deductible against your income, depending on what level of income you have. So that means depending on your level of income, they might say, okay, now you've contributed, we've already allowed you to minus the $23,000 that you've maxed out in your IRA. I mean, in your 401k, we're not going to allow you to, also max out another $7,000 and deduct that from your income. That's why I always say that if you have access to the 401k, make sure you max out that one first, just because you have a larger amount and it's likely that if your job offers a match, you get a match. There is no match in your regular IRA. Like if you just have a regular traditional IRA, there's no match on that. I mean, let me rephrase that. If you roll over your 401k to your IRA, it's a little shameless plug, little free one for Robinhood. I think they've been doing like a little 3% match as an incentive to roll over. So some companies will do that, but that's a one time.
Whereas, not an every time.
Right, but if you have it at your job, you're getting the yearly match
every time.
Every time of whatever it is that they're offered. And a lot of times the way these companies are set up, they're required to match every year or several years, 3 out of 5 years, or each one has different rules. So I would inquire to what they are and make sure you get that free money.
Yeah. Yeah. And these are like the most common accounts, and your money is being invested in the stock market, right? So like you were talking about the target date fund. So when you're younger in your career, just to like explain this even further, or from another point of view, you're going to be more heavily invested in stocks and less invested in bonds in these accounts when you're younger. As you get closer to retirement age, they start rebalancing that account, meaning they're trading the stocks for bonds. Is that correct?
Right. Yeah. So they start, in theory, because the thought is that stocks are more volatile and bonds give you a smoother ride. And as you get closer to retirement, they don't want your account fluctuating as much because you're getting closer to a point where you're going to need to start drawing from that account.
Right. So for those of you who are quote unquote nervous to invest in the stock market, when you're investing into one of these 401k accounts, your money is being invested in the stock market. So if that helps you kind of overcome the barriers on some of these other accounts that are having to be invested in the stock market for some reason, and I can't quite figure it out yet, maybe people have heard horror stories about investing money in the stock market and people losing all their money, but this is a very, very common way to let your money work for you. Right?
Yes.
Like we hear people all the time, well, I'm going to I want to save and invest in real estate and do this and do that. And that's great. If you have a passion for fixing up houses and being on call 100% of the time, go for it. Like go for it and invest. We were talking to someone and they wanted to invest in a franchise. Again, that's more work, right? This is like one of the most passive ways to grow your money in the stock market, and everyone is doing it. If they have a 401, anyone who has a 401k is doing it.
Absolutely. And when you think
And
about the wealthiest people in the world, like, they say that, especially when you're living in we're from Northern California, we live in North Carolina, and they say, real estate, it makes the most millionaires. And it does make a lot of millionaires in Northern California, just because those housing prices over the last, 30 years have gone up. So many people have bought houses for 100,000 or less, and they're now valued over $1 million. But the stock market makes the most billionaires. The stock market is one of those places where you get somebody who comes with a startup, and literally they design some company in their college dorm room, and now it's worth 30, 50 billion dollars, all that type of stuff. And so, the stock market is where billionaires are made. Also, a lot of millionaires are made just through 401ks. When I worked at a firm, I would see so many people come through who had accumulated millions of dollars in their 401k accounts, which is now, or their IRA accounts, just from saving through these types of accounts, making the contributions every year from their paychecks, and it just growing tax deferred. And the thing about these accounts is you're incentivized, because if you pull them out before you age 59 and a half, you get penalized. So people wouldn't touch it. They just have that money growing tax deferred, just growing, and it's making a ton of money. So, the stock market makes millionaires and billionaires. It's just, when you're investing in it, you want to make sure you're diversified. And maybe, I was just thinking, maybe we'll touch on this next week, which is, we'll do an episode next week on risk tolerance. What does risk tolerance mean? And what are the different things that you can invest in the stock market? Like, what's a small cap fund, a large cap fund, an international fund? What type of ride will it give you? And then just do some projections. We'll bring out like a little projector and show how much money you can invest in. What are the projections? So I was just, as we were sitting here just going through this, I was thinking that might be a good follow-up to this episode, because right now we're talking about the types of accounts you need. Next week, we'll talk about what you need to put into those accounts so that you can get the growth you're looking for.
Yeah, that sounds good. And I realize that we are like running out of time here.
Yes. So we're going to hop right into this last account.
Yes.
Yes.
Most controversial account.
Yes. It's just the same as a brokerage account, but this type of account holds cryptocurrency. And so it is taxed the same way and is set up the same way as a traditional brokerage account. There is no amount. There is no cap on how much you can put in. You can access your funds as much often as you want. If you hold the funds in here for longer than a year, it's long-term capital gains on taxes. If you hold them in here for less than a year and you've made a profit, it's short-term capital gains on taxes. If you've made some money. But these types of accounts allow you to hold cryptocurrencies or tokens, and this could be Bitcoin, it could be Ethereum, it could be other types of coins that you've seen. And this, in a place where you might buy this at, is Robinhood, Coinbase, Strike. And so once again, as I've laid out these different types of accounts, if for your checking account, for your cash money, you have a custodian. Let's say you use Bank of America, Wells Fargo, Chase. But for your stocks and bonds, let's say you use a brokerage account, such as you're on Vanguard, you're on Fidelity, you're on Charles Schwab, you're on Robinhood. Now, when it comes to holding coins, you have to have a custodian that allows you to hold those types of crypto coins. So Robinhood does allow you to hold crypto coins, or you could hold it on a Strike or a Coinbase. And so once again, different types of custodians allow you to hold different types of things. And so that's why we're bringing this up, because there are a few that would allow you to do everything all at once, but sometimes maybe you don't want to have all your eggs in one basket or everything at one custodian. So that's why we're just bringing these up. So this type of account is a brokerage account that allows you to hold cryptocurrencies. And, this is the new frontier in finance. And so it's growing a lot, and we've seen these types of assets continue to grow. Also, the government is getting involved, and they're having these things called CBDCs. And I heard somebody preaching on this, and they're like, no, I'm not talking about marijuana either. And so these are central bank digital currencies. And so, and this is where even central banks are starting to create their own dollars that are connected to like the fiat currency that governments send out, like, US dollars. But there are just digital currencies such as Bitcoin, Ethereum, Doge. You have meme coins, you have utility coins. And so this is something that is going to, just like if you're buying a fund, this is something that you would need to do a little bit more research on. And we did one episode maybe about 12 episodes back, a little bit just scratching the surface on Bitcoin and some cryptocurrencies. But this is something that I want to say that when you get involved in this, you want to make sure you have a deeper level of understanding. We're probably going to be running another episode on this 2 episodes from now on just giving a much deeper dive into this. But this is something that also you want to have some access to in your in your finances, into your investment portfolio. If you can stand the volatility, because it can be up and down, but it could be a great way to see some growth in your investment.
I would also just
what questions do you have?
Yeah, I would also just say, when you're on the internet, especially when you're like following other money people, I haven't really seen, I feel like I've seen 2 extremes. Like people who are like only crypto, like gung ho, like kind of over the top with it, which I think turns people off. And then I feel like there are money creators who like completely write it off and say it's a scam and you shouldn't put your money into it. And I really think there is an in-between point of view that is worth researching and worth going down the quote unquote rabbit hole of cryptocurrency. I mean, one thing that you said earlier is like the government is actually getting involved in this. And there are several countries where the government is getting involved in this. It's not just the United States. And so it is worth looking into. It is worth understanding. And this is one of those things that you don't want it to pass you by. This is like
We have a guest.
our guest, our favorite guest who gets very impatient with us. It's ready for dinner. So
Yes.
This is Gunner, everybody.
Gunner,
Our little blue staffy. He is
Say
the
hi,
joy,
Papa.
one of the joys of our life, but he's ready to eat his dinner. So,
Okay.
but I do think that if you have to put him
Yeah.
outside, you may
Okay,
want to.
Bob. I'm gonna have to put you outside because you're disrupting the show. Come on, let's go.
A pleasant disruption. But if this is something that you feel scared or nervous of, we have a couple YouTube videos. We went live on Bitcoin, one of our first shows. Gabe has a video about it. It's a short video just explaining the basics. Gabe has been deep diving on this topic for the last 6 months, and there's going to be more information to come. But this is really like meta in the 2000s.
Yeah, it's like the internet. It's like the internet for money.
Yeah. So it's something that's new, different. People don't really understand it. And so therefore people are scared of it. And it's just like any investing, the more you know, the more you understand, the more comfortable you can be with it. And again, obviously you want to invest with your risk tolerance, but I just want to say that because I feel like when people hear the word Bitcoin or cryptocurrency, like immediately people are turning off and thinking that it's a scam.
Sure.
And we would really encourage you to not do that.
Yes. And so I was going to say, I've actually been working, at Steadyworth. One of the things we do, our whole goal here is to make money simple and easy to understand. And we've actually been working on a few different, just white papers, like a few different PDFs that we've been creating to explain to people about different crypto tokens, coins, and just how they work, how you could use them, and how you could get it into your investment portfolio. If that's something that you're interested in learning about, and once again, we don't sell anything. We're literally just, if you would like to get one of our PDFs about that, it's totally free. Feel free to just email us, hello@Steadyworth, put crypto in the subject, say, I want to learn more about crypto, and we'll email you back a link so that you can download this PDF and just read about it. We would just love your feedback on it. See if it makes, see if you're able to, if after reading it, you're able to understand a little bit more. Our whole goal out here is just to equip people with knowledge so that they can be better prepared to participate in a conversation, so that, even when you're making up your mind, you can read something like this. You can say, hey, I can see how this makes sense for me, or I can see how I do not want to be involved with this. That is just our goal, is to get people out of the middle and to equip them with enough information so that they can take a side, but be informed about what side they want to take. So they can say, hey, you know what? I've read about it. I've learned about it. I'm good. I don't want to be involved. Or I've read about it. I've learned about it. I can see how this makes sense. I like to know more about how I can get this into my investment portfolio. What we just want to avoid is somebody being like, yeah, my friend told me they got scammed out of all their money. I don't know anything, but it sounds like a waste of time. Like that's just not the best.
Yeah,
thing.
knowledge is king here, right?
Yeah.
Financial knowledge is king here. Financial knowledge leads to financial confidence, which leads to financial legacy. So just remember that the more you can invest and learn in this type of stuff, in this type of investing and getting your money to work for you and feeling really comfortable with your money, the possibilities are honestly limitless. So I know we're over time a little bit. We do have people still watching. So if you have any questions, please feel free to leave them in the chat. What would be like if someone is interested in learning a little bit more about crypto or buying crypto, what would you tell them to do?
I would say email us, send us their email thing, I can send out the PDF.
Okay.
Also on our page, we have a video that talks a bit about Bitcoin and
Okay.
just kind of what it is and what it isn't. So you could go back and watch. It's a Sundays with Steadyworth. I think it was like the second one we did. So it might be 15 episodes back. So if you go to the YouTube page, hit live and scroll down, I think there's one called Bitcoin for Beginners or Bitcoin
Unpacked.
Basic.
Yeah, Bitcoin
And
Unpacked.
so yeah, and we're going to be touching on it not next week, but I want to say the week after. And
Okay.
so, another thing is that if there's something specific that you would like for us to cover, also you could email that in or put in the comments if it's regarding Bitcoin or crypto or CBDC, central bank digital currencies, and we can actually design an episode around it. And so that's one thing that we love to do is like when people have specific questions, we love to answer those questions.
Yeah.
And just
And
equip
if
you with
they
the
wanted to
knowledge.
buy it, where would they go?
I would say to go to Strike. Strike is if you're looking. So one thing, if you're looking to buy Bitcoin, go to Strike. From what I've seen, they have the smallest amount of fees. They have the least amount of fees. Like their fees is the smallest percentage because every time you buy a crypto, you pay a fee for it. If you're looking for other cryptos, like say you want to hold multiple different types, you could either go to Coinbase. I found that Coinbase's fees are a bit higher. You could also go to Robinhood. Robinhood has several cryptocurrencies that you can buy on their platform. Coinbase the same. If you're buying Bitcoin though, Strike has the best set of fees. But so I'd say either go to Strike, Coinbase, or Robinhood. Those are all great places to start on your crypto journey.
And this is my last question because we've talked about 5 different accounts to grow wealth. And this is kind of like a new emerging account, so to speak, to
Yes.
grow wealth. Like where, given your knowledge, your perspective as a CFP, right? So a certified financial planner, this is the gold standard of financial planning professionals.
Yes.
They're held to a ruthlessly high standard. They have to take, you have to take continuous education credits. Where do you see and you've deep dived on this topic over the last 6 months, like where do you see crypto playing a bigger part in people's portfolio?
Well, I think that as we go, I think the way that we look at our portfolios and the way that portfolios now are designed are all going to continue to be digitized. So right now, when you are investing in the stock market, it seems digital to you because you log on to an account and you buy shares in Tesla or Apple or whatever, but they're talking about moving these types of shares to the blockchain. And so this is a form of crypto once things move to the blockchain, blockchain technology. I think that also with central bank digital currencies rolling out this type of money, it would literally do away with paper money and it would be the own government sort of cryptocurrency. And so I literally see this as just as like the internet is like the future of textbooks. Like, I've heard that kids these days don't have books for school the same way that we had books and backpacks, but a lot of times they have digital ebooks and they have their Chromebook and they have their issued iPads or whatever type of things and laptops. And so they don't have all of the books that we had because a lot of this stuff is on their computers. Eventually, we're not going to have all of the money and the change and things that we have had because we're going to move over to all digital tokens. And with where we're at in the world, I can't imagine a world being any less digital than what it currently is. I don't see us going away from digital. I see us becoming more digital. Sometimes I would like to be less digital. And so I just think that this thing of cryptocurrency, I mean, we're talking about it as a money, but they're talking about how these blockchains are set up in these ledgers and how things are tokenized on these things. They're talking about doing this with real estate too.
Interesting.
Because, right now, let's say you were to buy a house, who knows that you own that house? You buy that house and then you go to a title company and they put that title company puts it on record down at the courthouse. And so there's court documents on that, but that court document, but who owns the courthouse document thing? The courthouse document runs basically the ledger that says, okay, John bought the house and sold it to Rachel. Rachel bought the house and sold it to Steve. Steve bought it and sold it to Amanda.
Yeah.
Whereas once we have it on a blockchain, we could be a decentralized blockchain where it's like, okay, now instead of it being on record at the courthouse, it's on a blockchain where everybody can see the record, and then we can just pass it back and forth.
Yeah.
Because that's one thing when we're talking about when we're sending something on a blockchain, it's peer to peer. And so so like if I'm sending you money on the blockchain, say I'm sending you Bitcoin, I send it straight to you. It's not passing through a third party. It's not passing through the bank. Whereas when we're doing stuff if we were transferring real estate right now with the way it's set up, we would need a third party to go set up those documents and then put it on record at the courthouse. Then it's official once it's on record. But if it's on the blockchain, we could pass it back and forth and it's on record as soon as we pass it.
Yeah.
And so I
feel like we could go.
Yeah, that was a longer explanation, but basically I see this as the new form of finance. And if you look into it just a little bit, I think that those watching will see it as the new form of finance too, because it's popping up everywhere.
Yeah. Cool. Well, if you're interested in learning more about this, please leave a comment. Even if you're watching this later and you're not watching this live, we would be happy to dive deeper into this. And like Gabe said, we can share a PDF with you as well, but let's close this thing out because we are overdue.
Yes.
We're going long today. So how do you want to close this 5 accounts that people need to build wealth out today? What do you want people to walk away with?
So I'd say to take action. I'm guessing if you're watching this, you likely already have a checking or savings account. 5 accounts may sound like a lot. So I would say figure out an account that you want to choose, whether it's a Roth IRA, whether it's a 401k from your job, or whether it's a traditional brokerage account. Choose a custodian. If you don't know one, get on Robinhood's website, get on Charles Schwab's website, get on Vanguard or Fidelity. They'll walk you through. They literally have instructions. You can get on that 800 number and call, set up an account, maybe set up all 3 of them, set up all 4 of them, set up a crypto account as well. Start doing your research. Get on ChatGPT, ask some questions. Hey, I'm setting up my first brokerage account, setting up my first IRA account, setting up my first Roth IRA account. I want to put something in it. I want to start investing this week, and I can't wait till next week's episode with Sundays with Steadyworth, and I don't know what they're going to say. Can you help me with some investment recommendations? Yes. Ask it, and then bring those questions next week, and we'll help you parse through them so that you can make an informed decision.
Absolutely. I think one of my key takeaways with this is really like, if you think about these 5 accounts as like a wealth building system, if they're all working together, you're going to be growing wealth while you sleep.
Yes.
And if they're invested and you're contributing to them consistently, you are going to be growing money while you sleep. You're going to have to worry less about money now and in the future. And so this is something like, if we were to answer people's question about what account should you have, really all 5 of these would be great. And of course you want to start small. You don't want to be overwhelmed, but I think, looking into this, getting clear, we also have a PDF that outlines almost all the accounts we talked about today. We do need to update it with the crypto accounts, but if you're interested in having a hard copy of that, please email us at hello@steadyworth.com and we'll send it over to you.
I'm going to leave you with one last analogy of these 5 accounts. And then it's like, if you think of them as social media, like if somebody would say, what social media should I get? It's like, you may have Instagram, YouTube, Facebook, TikTok. You have, Twitter, all of them, but they're all, even though they're all technically the same, they're all used for different things. If you're going to spend an hour watching a podcast right now, you're on YouTube. If you're going to watch some shorts from this, you might be on TikTok. You might be on Instagram. Yeah. If you're going to read an article or look to, connect in a group, you may be on Facebook.
Right.
And so I want to say that even though you're all doing social activities, there's different platforms that you would do them on. Yeah. And so I want to say that these accounts are all related to money, But depending on what type of thing you're trying to do with your money, there's different accounts you want to do it on. So, some is like long-term investing for retirement. You're doing that in a different thing. Some is for a brokerage account that you may need to have access to over the years. You're doing it in that type of account. Some is for savings and paying bills. You're doing it in that type of account. Some of it's for crypto, for the way the future finance is going to be. You're doing it in that type of account. So they're all the same, but all different.
Yeah.
Just like social media.
And I would just say, if you haven't started at all, start with what's easiest to get to, which is probably your employer retirement account, and then expand from there. And pick one account over the next 6 months one account a month that you're going to look into and get started.
That's right.
Yeah, break it out into a small thing. So this is really how you're going to create and grow wealth. And so we're so thankful that you spent time with us and joined us. If you have any questions, we do have a link in the description box below where you can book time with us. You can leave comments. Sounds like next week we're going to talk a little bit more about risk and how to identify what your risk tolerance is and how to make investment choices from that place. So
have a great day, and we'll see you next week.
Thank you guys so much. Have a great night.